So, welcome everyone. I'm Alexander Mihalchan, and today we have one of the industry leaders, Mark Tinker, CIO and Managing Director of Toscafund HK. Welcome, Mark. How are you doing today?
Good. Thank you very much. Nice to be here.
Awesome, and I'm excited to have you on the podcast today, and I'm sure you're going to be of great value for the audience.
Well,
Now,
let's see.
before we dive in, could you give us a quick overview of what Toscafund HK does?
Sure. So we're basically HK spun out of Toscafund Asset Management, which is one of the longest running hedge funds in the UK. Been going for over 25 years. We set up in Hong Kong about 4 or 5 years ago, and really our mission is to provide value-added investment products and funds and provide a platform for really smart, independent managers who basically don't want all the hassle of all their own compliance, all their own sort of back office, middle office. So, in a sense, taking people like myself, I was a fund manager with AXA Investment Managers for many years, who just want to manage money and don't want to deal with all the rest of it. But I think crucially, we're not like one of these pods which are for traders, short-term traders with other people's money. We're more a sort of an environment where good long only managers can focus on managing money, and we help them with the rest of it.
Okay, that's really fascinating. And what inspired you to join Toscafund HK? Was there a specific moment or experience that sparked this journey?
Yeah, I think what essentially happened is I spent 20 odd years on the sell side, as we say. So I worked for various investment banks as a sort of global investment strategist, and in back in 2006, I was offered the chance by AXA, the big French insurance company, who'd recently moved into the UK, which is where I was at the time, and they basically offered me the chance to put other people's money where my mouth is, as I like to put it,
Yeah.
and basically invest my ideas in a fund. So I spent many years doing that. In 2013, I moved out to Hong Kong. And then in 2019, I decided to set up on my own, which, like many people who weren't great on the timing about COVID, so I started to build business out in Hong Kong in 2019, 2020. And then in 2022, 21, 22, Tosca in London asked if I would help them set up a business in Hong Kong. So it initially came from them wanting to position themselves to benefit from the growth and what we all agree is happening in Asia and the whole environment out there. But essentially, what's happened, as I just explained at the top there, is we've now kind of moved on so that I'm taking the Tosca Fund Hong Kong business to the next level, which is this whole platform business. Because you know, I've set up a fund which invests the way I want to invest my own money. And I'm setting up a business the way I want to operate myself as a manager who just wants someone else to take care of all the back end of it.
Right, 100%. But for example, looking back, what would you wish you've done differently in those early days?
Oh, many things. I mean, one thing I wish I'd done different was not try to set up a fund just as 3 months before COVID hit. But we can never get that market timing right. I think yeah. So going back, I think I wished I'd gone to the buy side a few years earlier than I did. I went in 2006, but I think the really exciting time to have gone to the buy side was in 2000 sort of 2 3, just after the financial crisis. But I think one thing important for everybody to recognise is you can only grab the opportunities when they're presented to you, and very often those opportunities come. It's a little bit like you know. I got the opportunity to be a fund manager when there was already a bull market underway. And why is that? That's because the people that offered me the chance
Yeah,
had enough money and had enough, to take enough risk to take on someone from the sell side to the buy side. So my choice, you have to be careful. You have to take the opportunities as they present themselves, and they don't always present themselves at the perfect time. So, my choice for seizing all sorts of opportunities along the way was formed as much by the people offering me the chance. And so, you want to get in at the bottom of the start of a bull market, but nobody's willing to take any risk at the start of a bull market. So,
yeah,
you
right.
have to wait till you're halfway through. So, yeah, I mean, the hindsight portfolio always outperforms, as everybody says. Without wishing to sound too esoteric about things, that the Danish philosopher Kierkegaard says life can only be understood looking backwards, but it has to be lived looking forwards. So I think that's quite a good philosophy. I think for
Hmm.
everything to do with investment and life, really.
Yeah, yeah, right. But let's go back to when you first started. So, what major challenges or gaps did you see in the market that made you think this needs to be solved?
I think when I started out on investment management, I think the gap that I saw was that traditional investment management was very structured around sectors and countries. So you're either a US fund manager or a European fund manager, or you were the guy that did small caps, or you were the guy that did engineering or whatever. So I looked at that and said, well, why can't we do it globally? So that was the first gap. Why shouldn't we just look more holistically? And secondly, I said, why should we do it by those traditional kind of economic structures? Why, if we're investing for the long term in growth, why not look at thematics? Why not look at the themes that are driving growth? So I think my kind of breakthrough, so to speak, and why the initial funds that I launched, were very popular was because people said, actually, does that make sense? Why wouldn't we invest in themes like robotics and automation, or themes like sort of cross-border themes, or long periods of time? So I think that was the gap that we identified. And then working on that, having come to Asia, I also made the point, setting up on my own. I was working within a big organization, and the problem you have with big organizations is all the incentives are for the people that work in the organization. And that's the whole problem for anybody as a client, an ultimate investor, ultimate client, is that recognizing it's not these people's fault, it's the system. The system is designed to preserve the jobs of the people in the system first. If you end up making some money out of it afterwards, that's great. But the reality is, the big firm, they just want to have as many assets under management. And the management of these firms, what they care about is their job. So they don't want you to outperform and they don't want you to underperform. So they basically make you hug an index as a
Yeah,
manager. So as a manager at a big firm, most of your kind of talent is squashed because actually your manager doesn't want you to take any risks with his job. Your client might want you to take some risks with their money, but you're not allowed to do that. So that's the gap that I'm now trying to focus on, which is, I'm investing in my funds and I'm inviting people to invest alongside because, like, the interest is totally aligned. The client could fire me, but I'm not going to be fired by somebody for not making a you know,
yeah,
manager's job. So I think that's how I've seen the sort of thing evolve. And I'm not here to criticize the big guys. I'm just saying the big guys, that's not their job to manage your long-term returns. Their job is to manage their short-term returns in order to maximize their profitability. Their job is not to maximize your risk-adjusted returns as a client. And as long as everybody understands that, then we can all work out our place in the picture.
yeah. Interesting view. And for example, because you mentioned this other before, and in your view, how is China building a new operating system across various sectors to break away from US dominance?
Yeah, thank you. That's a very good question because it's very much a theme and a theory of mine. I've lived in China, effectively China, Hong Kong, which is China light, but it's very easy to go backwards and forwards to China. And so the first point I would say is that many people all over the podcast world and YouTube, etc., who talk about China, way too many have never even been there. And so we end up in this kind of self-referencing bubble. Somebody looks at some economic numbers and so on, and they all declare everything is terrible or not. Now, look, I'm not an apologist for China, nor am I saying everything is perfect about China. What I'm trying to do for people is say, you got to understand, look at China. The analogy I used recently is to say, if you looked at Apple back in the days of Steve Jobs, as if it were like any other company like GE, for example, like Jack Welch was in the process of restructuring GE and everybody was focusing on the balance sheet and what returns to shareholders and paybacks and dividends and buybacks, etc. If you looked at Apple in those days and said, "Oh no, Steve Jobs has got to pay more money back to shareholders, and he's not allowed to do X, Y, Z," you know, it would be completely the wrong thing to do. And I'm basically saying the similar thing for China versus the US. The US is restructuring. What's going on there is some very, very interesting stories, similar to Jack Welch back in the day. It's a mature economy. It's what's starting to happen in Japan, it's happening in Korea, it's happening in Europe. But in China, we are not just at Tim Cook's Apple, we're at Steve Jobs' Apple.
Yeah.
And so you've got to look at China like it's a growth stock. So when we say, oh, China should look at its GDP and China needs to boost its consumption and China needs to like get its inflation up because that's a bad thing, it's completely misunderstanding, in my view, what the people who are trying to grow China are focusing on. I say it's like asking Steve Jobs to pay a dividend. Now, the GDP or any of the other stats that we look at, like we look at the West, it's kind of an outcome. It's not, it drops out the bottom of the process. It is not what they are focusing on. And so the way I would suggest people look at it is that take the so-called housing crisis that you keep reading about. Right, so that housing crisis, what was actually the case, and the great thing about China is they have these 5-year plans and even 10-year plans, and they tell you what they're going to do, and then they go and do it. And we all sit around in the West going, why haven't they done this thing with a 3-month time horizon? That's because, again, we're looking at it the wrong way. So in 2010, ahead of Xi coming in 2012, they had a plan where they needed to move 150 million people, that's half the population of the US, had to be moved from the countryside to the cities. And so to do that, they needed to build accommodation for 150 million people. So what they did is they brought in the private sector to help. Now, there's a thing, if you go back to the days of Deng Xiaoping, he had a great expression, which is that it doesn't matter if a cat is black or white as long as it catches mice. And this is the way the Chinese still look at things. It doesn't matter if it's the public sector or the private sector, as long as we get those houses built. So what they did is they enabled the private sector, which enabled all of these property developers. And the way it worked, just very briefly, is that you put your money down, 40% deposit to build a new home, and then the property developer would use that to fund the working capital of building the home. But then what happened is it got to the stage that the property developer would use your deposit to buy the land for the next one after that. And then it got to the stage, well, the next one after that. So it got to be a lot of speculation came into the system, but the system was building the properties that were required. Then in 2021, we could all point to the fact that some of these developers were moving off to do electric vehicles and they were doing all sorts of other things with their money and the money that they had borrowed. And we all saw that. The fact is that most of the money that they actually borrowed from Western investors, from Western people investing in high yield bonds and from Chinese banks, but not from the Chinese consumers and not from the people whose homes they were building. So when Xi in 2021 basically said houses are for living in, not speculation, the whole bubble burst. And so all of those property developers basically went bust, except that the Chinese government insisted that they delivered the homes to the people whose deposit was already gone down. So that's the first thing. So nobody was made homeless by this. And secondly, to the extent there were speculative homes, recent moves by the government to lower interest rates and change affordability, again, we're all read up as this is a bazooka to boost the Chinese economy. No, it was to enable that excess supply to clear with demand. So what they're always doing in China, as I observe it, is basically they're trying to ensure there is enough supply of everything they need in order for the economy to develop.
Yeah.
Now, in the West, we have this idea, here's the excess supply. We've got to artificially goose up demand so that the people that supplied it can sell at a price that makes them a profit. Because, of course, those people are the ones advising the government. Whereas in China, they're saying, no, the price has got to come down to a level where it will clear with demand. So we observe deflation in China. We observe a boom in the what we would call the shadow banking system and then a bust. We observe a boom in the house building sector and then a bust. And we all say this is terrible. But actually, I would suggest people stand one step back and say, well, what have they achieved? Well, they've moved 150 million people from the countryside to the city. We then all say, oh, they've got all this terrible registration system and that's bad for human rights, blah, blah. But they've also looked at what happens if you let 150 million people move to the cities. You get favelas, you get townships, you get slums. Again, what they are good at, everybody says the Chinese copy. They do copy. What they also do is they don't copy bad ideas. So in the investment world, this is what the great Charlie Munger, of Berkshire Hathaway, referred to as inversion. So instead of saying, how can I do a lot of good for a country or a company, you say, how can I really mess it up? And then let's make sure, first and foremost, that I don't do that. So China's observed a lot of things that the West has got wrong and is deliberately not copying them. And a lot of people in the West are going, why don't they do what we did? Because we are great. And the Chinese are going, well, no, you're not. So there's many, many layers. So yeah, I think from an investment point of view, the biggest gap for most investors is is a kind of consistent and coherent viewpoint of what China is trying to do. It doesn't make it always you must put all your money in China, but it's an understanding of how they're trying to do stuff and what they're trying to do it for. And it isn't just to target a GDP number or just to target an inflation number. It is about building a whole
Yeah.
system. And yeah, that's the final point, as you referred to. The way I put it in that recent note we talked about was basically China, like Apple, is building iOS. And the West is like, we're like a bunch of Microsoft engineers sitting there going, why isn't it like Microsoft? Because, it's coming from a very different perspective. And in that, we should also throw into the mix that this isn't just about building an economy that is not dependent on the West, but it is about ensuring that all the systems are not. China has its own GPS system, which is actually, if you look on Wikipedia, is superior to the Western GPS system. But of course, what it's really doing is building its own banking system so that it's not caught in the US banking system and thus
Yeah.
subject to sanctions. And it's building its own energy infrastructure. Some fascinating stuff going on energy. So look, think of it as Apple versus Microsoft. They coexist, and you can have a this. I'm talking to you via a Microsoft 365 based PC, but we were talking on my iPhone earlier on about how to make that all work. So you can have both systems.
Yeah.
One is one adds different things to the other. So that'd be the kind of imagery I'd leave for you to think about.
Okay, okay, that's very interesting. But for example, what factors are leading investors to question the uninvestable narrative surrounding China?
Well, I think there's investors, right? So you have traders. Then you have your institutional investors, your big pension funds, insurance companies, and so on. And they are very much run by, as I described earlier, they're run by the middlemen. They're kind of they're civil service type structures, if you like, and they're very rules based. And they will
Okay.
follow whatever the rules are because that's how they are judged, that's how they are paid. And then underneath it all, you've got the long term investor who maybe he's delegated a lot of his savings to his pension fund manager or his mutual fund manager, etc. And it's all targeted against benchmarks and it's all really quite automatic. Now, the thing that's happened, of course, is partly for geopolitical reasons and partly because of what I just described in areas such as those housing developers and so on, is the guys in the middle have got caught out. So you invested in Asian high yield bonds because that was in your benchmark, and then the Asian high yield bonds happen to be 40% property developers in sort of offshore bonds for Chinese property developers. So the guy that you delegated to put 40% of your money into the benchmark, and then they all went to zero. So your view of Chinese bonds is they're all terrible because
Yeah.
you lost your money. But it was just that particular part that was in an index that had actually been created by JP Morgan or Morningstar or whoever. So the first thing is actually when you had that shock, you had a second shock back in 2021, which was they also announced about the with profit education system. So what had happened is we had what were known as ADRs, which were certificates that could be traded by Western investors. That you had this kind of magical thinking that they were 100% owned by a Chinese company, so they could be uh, registered in China, but equally they're 100% owned by Western uh, company as well, so they could be bought in the West. So we had this kind of, and it was fine as long as everybody pretended there wasn't a problem. Now, a lot of these US retail as well as US institutional investors own things like Alibaba and you know the big names through an ADR, through a depository receipt, American depository receipt they were known as. And what happened was when uh, Xi also announced back in 21 that you shouldn't have speculation in education and some of the sort of the public goods. So what's happened is that the West, when the West goes into an emerging market, generally what it does is it tries to um, take over or create equity for the telecoms and the and all the public goods, if you like, all the utilities, the banks, the telecoms, all the kind of sort of basic parts of the economy, and then own all that equity. And they did the same with China, but they did it through these ADRs, and we had this growth in the education side of it. And so when the education ADRs were essentially depth charged along with the housing market by the Chinese authorities, then everybody suddenly lost a big chunk of their money in the education. So they then started getting out of everything else because they were thinking the same thing was going to happen. So it became uninvestable through the vehicle. So for a retail investor, you had these vehicles which like can't trust these anymore. I got to get out of this. Then you had the institution who basically had been hurt and wounded, and then we got the geopolitics.
Yeah.
So you'd have a lot of these, whether not just American but Canadian, Swedish, Dutch, etc., where the government would say we shouldn't be investing money in China because we've now decided China is a geopolitical, enemy, threat, competition, however you want to put it. And so what you then had for a period of time, what I would call a distribution effect. So every time you got a rally in anything to do with China, some big holder would go sold, sold, sold. So you basically got every rally was sold. Now, I would say probably this time last year, we got to the end of that process. There was nobody left to sell, if you like. But there was quite a few people at the trading end of things who were short. And what we got last September, October, we got this big sudden squeeze upwards in Chinese stocks. So they went up, the market went up 50% in a month or something crazy. Now, I think what happened there is that a lot of investors then thought, wait a minute, that actually is a big market. I've been reading all over the summer how China's gone from nowhere to have, completely dominate electric vehicles. It already dominates everything to do with uh, renewables in terms of wind and solar, etc. It's doing some amazing stuff in its energy. Actually, the currency hasn't collapsed like certain people sort of said every 6 months for the last 10 years. All these doom and gloom things actually haven't paid out. The market's just gone up 50%. Maybe I should have a look.
Yeah.
And I
Right.
think what then happened is that the long-term investors started going, let me have a look. And then some of the ones who weren't being controlled by local authorities or local governments, whatever, started to think, well, if I've got the flexibility, am I really happy? And this is a twofold thing. I said, no, am I really happy having 75% of my global exposure in the US and nothing at all in China? Maybe I'll take 10 out of America and put it in China and see how I go. And so just by that sort of behavior, China became investable again.
Yeah. Right.
And I think what we've seen this year is a shift from a kind of bear market spike, stabilizing, and I think we've now moved into a multi-year bull market. And I think we're now starting to see that flow. And there's still people who are very wary about it. And look, that's why there's, as I said, there's loads of things all over YouTube saying China's in a terrible state, so you're fine that you didn't put money in it, and people lap up something that reinforces, their prejudices. And I'm just saying, stand back a bit and look and go, okay, fast forward 5 years. What is more likely? China has grown, or China's gone forward 5 years, or gone back 5 years? Um, I'm not sure I could say the same about the UK right now. And there's some very interesting stuff going on in Japan, but that's a mature market that's restructuring.
Yeah.
US, mature market that's restructuring. China is growing in every dimension. So I think that means the long-term investors coming in saying, yeah, I'll have some of those. Alibaba's gone up 100%, right?
Yeah.
Okay, it had gone down a lot. But people are saying, I missed that first 100, but maybe I should look again now because actually I missed Tesla going from 10 to 20 and now it's 500. Do you see what I
Yeah.
mean? No, it's not 500, well, it's in splits, whatever. But you know, see what I mean? And back to my
Yeah. Yeah.
analogy. You know, Warren Buffett didn't buy Apple until it was 35 bucks. Great, because it's now 250. But Steve Jobs, it was 35 cents, right? So, you know, so Warren Buffett bought the kind of clear value growing trade in 2016. Absolutely right. Perfect for him. But there was also an opportunity to buy it 5 years earlier in the era of Steve Jobs.
Of
Um,
course.
so I'm making that analogy. You don't
Yeah.
go all in on China, but you say like it's just like having a diversified portfolio. So if you want growth in your portfolio, instead of just having everything in Nvidia, maybe you should be looking at incorporating China and its wide range of opportunities.
Yeah. Yeah. For sure. And now, walking us through how Tosca HQ addresses these challenges, what makes your approach unique?
I think, I mean, we have a particular fund that we've launched, which is a global thematic fund. And in that fund, we try and capture a number of the long term themes and we allocate to those global themes, including China tech and so on, via what I call a conviction scoring process. So the idea is I'm putting my money to work and my clients' money to work. But if I haven't got any conviction about the risk return opportunities that are out there at any particular time, because you can have great opportunities, but it's way in the price, shall we say? So it's
Yeah.
the thing about the thing about running funds is it's not just about coming up with good ideas because good ideas are shared widely and you give your and obviously now the AI can go around and scrape up everybody's good ideas. It's how you build a portfolio from those ideas. You're very often talking to someone who says, yeah, I was an early investor in X, but it turned out they had like 0.1% of their fund in it, if you see what I mean. Or alternatively, somebody was a bit later, but they had a much bigger weighting. So it's all about how convinced you are of the opportunity set. So we have a systematic way of doing that. And obviously, like most people, but I think we're a bit ahead at the moment. We actually have some proper AI architecture on top of that, which enables us to risk manage what we call the left tail. We've got a basket of stocks, take out the ones that are clearly much higher risk, but they just happen to be in a basket. But also help us discover many more interesting ideas and many more interesting signals, not as traders, but as long-term investors. So what's different is we're not traders, but we're using a lot of those trading tools to help us make longer-term investment decisions. And what AI is helping us do is not have to hire 200 analysts and not have to hire 45 managers to interrogate those analysts. We can do it with a much sort of tighter group of people. And you put that technology together with more than 30 years of actually being in markets and understanding how markets work. And I would also add in our approach is to have a behavioral finance overview, the understanding that a trader will be behaving differently than the institutional investor or the long-term investors I've just been describing. Each one of them at any point in time could be the person setting the price. But if
Yeah.
you're a long-term investor, it's very often not you, and you have to decide whether you're going to just stand back from the noise created by the trader who's just trying to generate lots of quick wins, or to stand back from the panic, either the panic in or the panic out from the institutional investor is being told he has to buy because he's underweight, or being told he has to um, sell because he's overweight, or because his mandate has changed. So understanding the people behind investing as well as the things you're investing in, I think that's probably where we would stand out. It's a kind of human plus machine, if you like. Man plus machine is more powerful than either on their own. So us together with systems and quant and AI, we think is better than just a pure quant or a pure AI, or a pure individual without any of that. So we hope that we put together a good mix, and focusing, because of our experience, and focusing on the basics, which is I've got to put together a portfolio. If somebody says, "Oh, you didn't beat the S&P last week," well, that's fine, because the S&P's got a whole different set of risks than I really want. And if you want me to beat a risky thing, you have to accept that I will take more risk. But everybody's kind of somehow been educated to think that you can get an index beating return whilst taking less risk than the index that you're focusing on. So you have to say, is the S&P 500 really my benchmark? Or am I just somebody that wants to compound my returns at 10% every year for the next decade? In which case, I need a different balance of strategies um, within my personal portfolio. And this kind of, I call it FOMO meets MOMO. MOMO is momentum. So people like chasing things that have gone up, and that is there is method in that madness. I'm not dismissing it at all. But you've also got FOMO, which is so and so made money last month by actually taking a lot of risk. In hindsight, they didn't take any risk because it didn't blow up. But at the time, the probability of blowing up was high. So it's managing that whole kind of mix of uh, influences, rather than just saying, yeah, I picked these three stocks. Um, and the other thing I would just say for your viewers and listeners is that, depending where you are in your lifetime, where you are in your wealth, if you like, if you want to accumulate wealth, you have to have a relatively concentrated portfolio of assets, and that includes a small number of stocks, not a large number of stocks, and you have to be cognizant of the risks you're willing to take. And it may be one of those risks is you just buy and leave it alone and let it compound, and don't keep marking it to market with the risk you might sell at the bottom or the risk you might buy at the top. So if you're accumulating, you want to be relatively concentrated, and focus on higher risk, but relative in that sense, relatively concentrated. Once you've got money, most people are very happy about wealth preservation. So therefore, they don't want to put it all in Nvidia, because Nvidia could drop 30%. They don't want to risk that. So they're happy to only get 8% upside if it means they're not going to get very much downside. So to criticize people, as too many in the press do, say such and such a fund didn't even beat the S&P 500, that was never its intention. And some of the very, very finest investors and traders, if you measure it like that, like the popular press do, apparently don't know what they're doing. But of course they do. So you just have to understand that people have different return profiles because people have different risk profiles. So as a viewer, as a listener, as an investor, you've got to work out what it is you're trying to achieve, and avoid the FOMO, avoid trying to fall for the idea that you can get money for nothing, and so did this in Bitcoin, and so did this in Nvidia, and anybody that did less than that doesn't know what they're doing. That's not the way that investing and wealth accumulation and long-term growth works. It's the equivalent of saying China is stupid for not cutting interest rates to zero and making everybody borrow money and buy stuff. China knows that's a dumb idea, and that's why it's not doing it. And it's the same for investors. You've got to work out what your liabilities are, and then work out what assets you need to match your liabilities. I know that sounds so obvious in some senses, but nobody talks like that these days. It's very strange.
Yeah, right, right. And this is also my one of my curiosity. So, for example, how can long-term investors avoid being distracted by short-term quarterly earnings numbers?
Yeah, that's an interesting subject. I mean, Trump just came out and talked about that, and everybody, the FT in particular, that I was reading, I'm sure many others were saying, this is really bad because it takes information away from price discovery for investors, etc. My view is the opposite. It doesn't actually, because what you ended up with was way too much focus on teaching to the test, as we call it, so that the management would deliver a smooth earnings number. And so actually, it made the whole thing artificial. And what we will do by moving to annual or semi-annual, I believe, is we'll have less noise, and we're going from here to here. Doesn't matter if after a quarter it's down here, because actually what we're really going to focus on is what is the real underlying trend in earnings, as opposed to just meeting those quarterly numbers. And two things happen as well, one of which, particularly in the US, it is a bugbear of mine, with stock options and share buybacks. The real beneficiaries of a lot of this noise um, are the management themselves, not the underlying shareholders. Um, and the too much focus on producer capture, as we call it, the insiders, what it means for them, what the share price does. Management shouldn't be focusing on short-term share prices. They tend to because they've got lots of options. Personally, I'd get rid of all those stock options. If you want to invest in the company, you can do like we used to have at AXA. You can buy shares in the company at a discount, but you have to use your own money, and you have to hold on to them. Uh, just getting granted options, which you then immediately make a good earnings announcement, share price pops up, bang, there goes the options. That sort of stuff. It happens too often. So actually, if we move away from quarterly numbers, I think that's good. Enables us to focus on the underlying business. Good management can focus on the underlying business as well, and a return to analysis. A return to, you know, it used to be the management said it was 10, now it's 11, so we just writes down 11. So there's no actual research done anymore. So I think if you have bigger gaps between announcements, I think there's more room for proper analysis. Therefore, there's more room for proper analysts to add value to the longer term investor. So I think it's a good thing all round. And what happens is that it's like I talk about the non-farm payrolls that everybody gets excited about every month. Look at what's just happened. They've all been revised away. All that growth that what there was there or wasn't there. And Trump is talking about sacking the statistical person. What we've actually had, of course, is high frequency traders, and it's almost like sports betting. They'll all sit there ahead of the first Friday in the month, and they'll say, "My basically the economist will say, well, the trending moving average is 140,000 jobs, so I'm going to basically guess one standard deviation above or one standard deviation below, and that's where we're going to go for." And then they'll all crowd around, they'll all put their bets on, and it'll be like the start of a horse race, and out will come the numbers, and there'll be a big flurry of activity, and then it's all over till the next month. And what
Right.
has that achieved? It's created a whole lot of noise, which hasn't really helped anything in the investment world. It's helped some kind of sports betting types who happen to be sat in trading pods, in investment banks playing around with lots of money. So look, they'll have to find something else. They'll find something else than all the sort of excitement ahead of the Nvidia earnings number or whatever. They'll just move on to something else, and I think we'll all be better off as investors.
Okay, interesting thing. And now, looking at the broader industry, what are the key areas of focus for Toscafund's investment platform spanning financials, equities, and private equity?
Yeah, so we're doing we have a number of people coming onto our platform, and across the board, essentially where we think it will add into a portfolio. So it could be private credit, could be listed equity, maybe listed equity with exposure to the whole AI infrastructure place. It could be um, uh, a private equity offering that we think is getting exposure to emerging China, etc., etc. So we have a number of strategies that we're in conversation with, but our driving force is like, we're going to invest in all of these things. Like, what do I want in my portfolio? I look around, there isn't something out there. There might be something from one of the really big guys, but it's kind of diluted and blended because it's a very big offering. We're interested in kind of smaller, new and creative people coming along to the platform that we can invest in and invest alongside. And obviously, as I said, I've got my core fund, which is UCITS structure, which invests in global thematics. So basically, taking me right back to my 2006 days of why do you want to be just betting on one country or one sector or even one style. So it's a diversified way of getting exposure to global equities in a for the underlying investor in a buy and hold way. But obviously we're doing the activity about whether we're switching into gold and whether we're switching more into mining stocks or whether we're actually switching more into robotics or into internet security or into the future of defense and things like that. So we've got all of these themes running, and we're just managing that as a sort of. So that's our core focus, but then interesting strategies coming in alongside that we think will fit into a properly balanced wealth portfolio for people to essentially it's fun to do stuff in markets, but actually it's hard work and it's a proper job. So do you want to hand over to people who are doing the proper job really? Uh, and hopefully keeping you out of trouble, keeping you out of bear markets, keeping you in bull markets, right? So we're always looking for, there's always a bull market somewhere, and we're always looking to see if we can get exposure to it while it's running.
Yeah, yeah, 100%. And before we wrap up, I'm curious about what's on the horizon. So, when you look at Tosca Fund HQ journey over the next few years, what possibilities excite you the most?
We're looking at working with the sister group in Hong Kong in the wealth space. We have a number of collaborations in the wealth space. I think for us, the excitement is going to be delivering more of an end solution to clients based around building our infrastructure of really high quality products. So the high quality products, as I described, that people can buy individually, but we're also, I think, the excitements for the next 5 years will be working with some colleagues and some people that we already work with to deliver almost like a private label solution, right? So this is taking all our best bits and putting it together in a way that works for that particular type of client
Yeah.
and delivering a solution. So it's almost like we got some pretty good chefs, and we basically are going to open a range of different restaurants, some cafes, some brasseries, some high end restaurants to use all our ingredients. So that's probably a good imagery that we're moving from being what do they call them, black kitchen chefs, to actually opening our own restaurants.
Yeah, sounds fascinating. And for listeners who want to learn more or potentially work with Tosca Fund HQ, what's the best way to get in touch?
Well, if you want to know a little bit more about what I'm thinking about markets and so on, I have a Substack called Market Thinker. .substack.com. That's where I kind of put my ideas out, the stuff we've been talking about, China and so on. But if you are interested in working with us, in the best instance, you can actually you can just write to me rather than admin. That means I'll definitely get it. So that's M Tinker. That's my name. That's for Mark, Tinker, at Toscafund, Toscafund, HK for Hong Kong, .com. So mtinker at Toscafund Hong Kong. If you're interested in finding out more about the overall business and opportunities there. Just quickly, we're not in the process of hiring outside of Hong Kong at the moment for visa reasons and so on. So please don't send lots of emails asking for a job. Much as we'd like to employ people all around the world, it's not something we're in a position to do outside of Hong Kong at the moment. But anyway, if you're interested in the business, please contact me there. And if you're interested in my ideas, then as I said, Market Thinker, play on my name at Substack.
Sounds great. And thanks for joining me today, Mark, and for this amazing podcast session. And for anyone listening, make sure to check out Tosca Fund HQ socials below in the description because this episode was packed with value and I can wait to see what you build next.
Thank you, Alexis.
Great, and see you on the next episode.
Okay, enjoyed it. Thank